Welcome to the Facts versus Feelings podcast. I'm your host, Ryan Detrick, and I'm joined by my co-host, Sonu Varghese.
Cutting through the noise in 30 minutes each week with Ryan Detrick, Chief Market Strategist, and Sonu Varghese, VP Global Macro Strategist, taking out the boring and helping investors focus on what really matters. A quick note before we start the show. Investment advisory services offered through CWM LLC, an SEC registered investment advisor. Carson Partners, a division of CWM LLC, is a nationwide partnership of advisors.
You're going to love today's podcast, episode 101 of Carson's Facts versus Feelings. We're joined by our good friend Frank Cappelleri over at CappThesis. Frank's been on the podcast before. I'm a huge fan of him. And what's really cool about this week's podcast, we recorded it last week down in Florida, in Orlando at Excel. I know Sonu and I learned a ton from Frank. I've been a big fan of Frank for a very long time. He's a market technician. What does that mean? Well, don't go away just so you hear the word technician. Yes, Frank looks at chart patterns and relative strength and seasonals and different statistics. But he really is one of the greats at doing that. But he also is really, really good at explaining what is happening. So many technicians talk about things and honestly confuse you. Frank does not do that. So without further ado, here is episode 101 of Carson's Facts versus Feelings, live from Excel down in Florida. Here you go. And away we go with Sonu Varghese.
Varghese, my new name.
Has a joke there. It's an inside joke, everyone. Welcome to episode 101 of Carson's Facts versus Feelings with Ryan and Sonu. We're joined, extremely excited to be joined by our good friend, colleague, all-around good guy, Frank Cappelleri. We are titling this one, Talking Charts with Frank Cappelleri. Frank, how do you even talk about charts? I mean, I thought that was a kind of cool title. Can we talk charts?
You're going to draw some with your hand? Just go like that.
Well, I've been trying to do that for the last almost 30 years, so I think we can probably hack it today.
We're excited to be here. Frank, I think you've been on at least once. How many times have you been on this podcast? One? This is your second?
This is the second. Last time was Facts and Feelings at the Excel conference last year.
That was a
in Nashville.
megapod.
Okay,
yes.
the megapod. So
with Sam Rowe and from Bespoke as well.
Yeah, you've graduated to a solo spot apparently. So or nobody else wanted to be here. It's like lunchtime. Nobody's here yet. But anyway, so we're excited. Frank, tell us your title and a little bit about what you do, how you help advisors. And I know you do a lot with Carson Group. How you do stuff with Carson Group.
Sure. Well, guys, thanks a lot for having me. It's a pleasure to be here again. And so we started CappThesis now 2 years, actually 2 years this month, after more than 25 years on Wall Street. So I do a lot of daily market commentary, of course, on the technical side, trade ideas, and that comes in notes and also videos. And so in terms of financial advisors use it, a few different ways. Some people just like the trading ideas. Some people just like to look at the content and be able to have an eloquent conversation with their clients when they call up. In a time like this, when it's volatile, just having your hand on the wheel is something that gives their clients some confidence and just has the ability to complement the things that you guys provide as your investment team to the clients as well.
No.
Your stuff is great. I'm still waiting for the hat, by the way. Frank does have some cool CappThesis hats, and it's a little worn down look, but I would have worn it.
You brought some, and then someone took them all at once, right? Kind of like Halloween, where you walk away and everyone took your hats. Is that what happened?
That's exactly what happened. Monday evening, I had about, I put 10 on the table.
I blame Sonu.
Gave one.
I don't have any.
I thought the coast was clear at about 7:50. 10 minutes later, they were all gone. So I know who you are. There's cameras here.
Okay.
Yeah, well, I guess it's a good thing. Totally off subject, totally off the subject. But it's the last day at our Excel conference. We've got a ton of fun talking with people. We've got, another 40 minutes or so to get into it with Frank. So, guys, this is for the YouTube channel. I'm wearing this do you like this? This collar's good. I've never wore this.
Yeah,
it's pink.
New threads. I haven't seen you in pink.
My wife and I were looking for a shirt or a jacket. Says, let's get something crazy. I'm in Florida. And then the team, as I walk up, the team points at my shirt. I'm wearing a white T-shirt, and it's got like a big pink stain. I'm like, this is brand new.
I'm not even guessing what that was, but
I mean, yeah, I know. No, it's just like it's literally in the bag. I just took it out. I just put their shirt on. I've got a stain on it already. Frank, do you have that problem? I mean, I can't do anything without spilling something on myself.
I do, but I will say that I think Dan Ives is going to be a little jealous of that one.
I was thinking of Dan actually when I wore this. Yeah, this is a shout out to Dan.
Just need some purple pants now.
Yeah,
Next time.
Or the moon boots from last year.
I'm wearing socks that say barbecue on them, so that's close. But all right, well let's get into it. This again is day. I guess what do we call this? Day 3.
Day two of Excel. Day 3 of us being
Partner
here.
Summit was
So,
yeah.
I
But this is we'll just call it the third day. Third day out in out down here in Orlando at a beautiful Marriott. At Excel. So, Frank, let's just get started. I mean, Sonu, you jump in as well. Sonu, I definitely want to talk to you about inflation because that data just came out. But before we started,
we have 2 hours.
I don't know how long this. Yeah, we can just keep going. It is 9/11. Frank, where were you? 9/11, because we're recording this on 9/11. People probably won't listen to it then. But where were you? If my math is right, 23 years ago today.
It was in the middle of Times Square. Wow. That's where our office was.
Wow. Okay.
So you can just imagine. And I remember, everyone has a story, but that was the first time actually being scared at work. And a side story is my wife at the time was working for Governor George Pataki, right, in the main office. And I remember, I still get goosebumps thinking about it, but she was on the phone when George Bush called up and said, "We are under attack."
Wow.
And so there was a lot of emotions going through, of course, my mind personally and overall. And I just remember walking across town to her office and calling and saying, "I can't leave." And she didn't leave for, I think, 3 days. So it was,
Wow.
a lot of people got lost the days and that day, of course. And, we think about them all the time, especially on the anniversary.
Yeah, no, I remember. I was in grad school in Indiana at Purdue at the time, and I like to think that's actually what changed, I think, my trajectory in a lot of ways, because I came to the States as a grad student. I wasn't expecting to do a PhD. I was doing a master's in aeronautics. I wanted to actually get into Formula One with doing aerodynamics and things. And I'd finished 1 year, and we were having the career counseling fair on 9/11. So I was dressed up, coming down, and my roommate says, "Some idiot just hit the World Trade Center." I was like, "How do you miss that?" So I'm standing watching it, and then, the second one hits. And he says, "Okay, I guess we're not having the career counseling fair. Nobody's going to come into town." And then nobody came in. There was no travel, obviously, the next week. And I talked to my advisor. Obviously, the prospects of the recession was just starting, 2001. And I was like, okay, what do I do now? I'm a grad student, international grad student, and my PhD advisor, eventually PhD advisor, he was still advising me on my master's thesis. He said, "Look, you're doing well. Why don't you stick around for a PhD?" I was like, "I don't want to spend 5 years doing a PhD." He's like, "No, you'll be done in 3 years." All right. So I was done in 3 years, actually, after that. And then I was like, "I don't want to do engineering anymore." He comes out with, I have this project. It's on derivatives and options modeling. Do you want to be involved with that? I was like, "What are options?" And but he said, "I don't know either. We learn together." And so we did, and here I am.
I was going to say that's an incredible transition.
Yes.
Because of that reason.
That is. I graduated from Xavier, didn't have a job yet, obviously September. Just kind of sleeping on my parents' couch or something, and it all started and watched it there. And I had 2 really close friends, like one college roommate and one really good friend. They were in the second building that I hit. Fortunately, both were out, but I just remember that day trying to call and get a hold of everybody, and phones weren't working because everybody's using their phone back then. And it was obviously a terrible day in our country's history. Lost a lot of great people, but let's just remember them and do the best we can this podcast to honor them. And we've got about 35 minutes or so to jump into it, Frank. So first question, it's a lob. It's an easy one. We still in the bull market?
Yes.
Do you think it'd stay in one?
I think obviously it relies on a number of factors. And so one thing I'll bring up is because Ryan has talked about many times on his Twitter feed, stating that we have a 6,100 target on the S&P 500, which has been in place since in January breakout through 4,800. And so I get questions a lot about that. Is that still an objective, and when will it be hit? And so, yes, it is. And the way that price patterns work, or bullish price patterns like that, when you have a breakout, you respect the breakout, and the target remains in play as long as that breakout zone holds. So the benefit of having that happen in January and having the market rally so much is that giving now the S&P 500 the ability to back and fill a number of times and potentially form smaller bullish patterns along the way, which will eventually get there. And so we already know we already had the pullback of about 10% in a very short amount of time, and potentially another one similar to that right now, all happening, as we know, in a time of the year when you typically have volatility. And it really reminds me a little bit of 2020. Now, clearly, not apples to apples and stuff. It's the fact that we are now in an election year again. But during that time, of course, the historic comeback from COVID, market was up about 45% by the time it got to that June peak early on. And then from that point, consolidated over the summer, broke out again. And at that point, identified a similar looking bullish pattern that had an objective about 32% higher. Now, no one wanted to hear that at all because of how the historic comeback happened so quickly at that point. But again, respect it until it's there. And if you remember, in September and October of that year, 10% pullback September, just about 10% pullback in October, right before the election, and then that target was hit 11 months after, about 32%, about as of 4,200. So we are about 9 months into this current one. Again, no timetable on it. From eyeing it closely, and again, you don't want to have the market pull back all the way to 4,800 before we get bearish. But right now, I would say I have a neutral stance because I become more bullish when there is identifiable short-term pattern target in play. Don't have that just yet. Potentially have a higher low in place right now, but there's a number of factors underneath the surface that I want to see change before we get really bullish again.
So let me go to you in 1 second. So when did you come out with the 6,100 target approximately? When did you start sharing that?
Mid-January.
Mid-January, okay. Because I remember when you did, I was like, oh boy, this will fire everybody up. So I shared that.
You sure did fire people
We can share, we can go back and look, but I remember the comments, right? People hated that very optimistic target, and the inner contrarian and they said, oh boy, we're probably gonna have a pretty good move. And yeah, I mean, stock's nearly up 20% for the year. I'm fully aware they've pulled back so far in September, which we'll get into. But again, that call was a good call and very contrarian, I think, and still I'm glad to hear it's still in play. Go ahead, Sonu.
I have a question. You mentioned breakout a few times there. I mean, I don't do technical analysis. Can you define breakout and how you think about breakout and what is it breaking out of?
It's a great question. Well, breakouts can come in different forms. Classical chart patterns, you probably heard the term, cup and handle pattern, inverse head and shoulders pattern. Sometimes really, I think, and getting back to Twitter, because it's a great sentiment read, there's so many people that take issue with how anything looks on there. And so I always say, I don't really care how it's labeled or how you measure, like how far one shoulder can be for the other one. If you have an understanding of what the structure looks like for a bottoming formation or a bullish formation, you know when there's a clean breakout. So another part of this discussion is that what constitutes or what makes bullish patterns work so well. Because if I go back to October 2023, I've counted 9 different bullish pattern breakouts that hit their target. So 9 successful bullish patterns, not counting the big one. So that's really what got me bullish about the big one. Now, why did those work out so well? Well, there's a few things. Number one, you have to have a clean breakout. That means you're breaking above a resistance point or prior high, and that breakout zone cannot be violated. So we need a clean breakout. So the question is, what causes a clean breakout? Well, you have to have really low two-way volatility. I measured that by just tracking the number of 1% moves in the S&P 500 on a rolling basis. Because if you have low two-way volatility, a lot less 1% moves, that means that there's fewer whipsaws. And all that together produces the probability of hitting an upside target much more frequently. So what do we have now? The opposite of that, right? So for instance, over the last 28 trading days, we've had 14 1% moves on an absolute basis.
I didn't know that. That sounds, that's clearly a lot. Yeah.
In fact, great point, because that's 50% of the time. The last time we had a rate like that, 2022, when there's 51% across the 12 months. So when you're measuring 5 to 6 weeks versus 12 months, not exactly apples to apples, but we can see that if this type of volatility, whether you want to talk about the VIX or the way I'm measuring it, continues, then you're just going to have a very messy trading environment at best. At worst, of course, things can roll over even more than they have.
So we've talked about that on our podcast before, where big up days actually maybe are not what we should root for, right? 2008 saw more 3 and 4% up days than just about any other year in history, yet stocks dropped 38.6% on the S&P. So great point there. Frank, so we came into August and we had the extremely volatile first 3-4 days of August, right? On the yen carry trade, the concerns over the economy, call it what you want. I think on a closing basis, about 8.5% approximately peak to trough correction on the S&P, maybe a tad more intraday. Then early September, as we're recording this, or kind of mid-September, I guess, we're starting to see that standard September volatility weakness. Why September? I mean, we all knew it. You cited it. I cited it. Worst month since 1950. Worst month the last 10 years. Worst month the last 20. Third worst in an election year, and only October is worse in an election year. Why in the world is it, you think? I don't know. I guess my take is I'd rather know than not know, and sure enough, here we are. But do you have any theories as to why it is? Because boy, oh boy, it's happening again.
I think at this point, it's a self-fulfilling prophecy. Everyone knows about it, and you get to the point where there's, coming into it as well, technology already had some issues, right? And just by the, mere math, if those stocks start to roll over like they have, then the major indices are going to suffer. And I think that sometimes it's not fully like that, of course, but reminds me a little bit, we mentioned 2020, but also, last year as well, where it came back and we started in August. Remember, the peak actually was in late July, early August.
Oh, we had Tom Lee literally at the peak. We were wearing bull horns. Okay, trust
Exactly.
me. Sonu and I remember.
And then it
the
went
peak.
downhill after that.
Literally to the minute, I think, with bull horns and Tom Lee was the peak before 10% correction. So yeah, we nailed that one.
Well, I remember actually talking about it September 13th and 14th last year during our discussion, because it looked like we were having a higher low develop in September, and that I think got squashed a day later. And then we had to go down until October, mid-October. And so, it's not always going to be exact, but it is interesting that it does happen around this time. And so I think we just have to understand what it is and just be prepared for something, different to happen at some point.
I'm just puzzled seasonality hasn't gone away, because you would think like everybody knows it. I mean, Ryan's popular on Twitter just by following what he does, let alone a lot of other folks too. Like, look, if you know September is going to be down, you would think, okay, let's sell in August then, right? And then you would think that September seasonality of, poor market returns is sort of arbitraged away, but it's clearly not. And I'm curious do you take seasonality into account? Like right now, okay, stocks are generally volatile around this time, especially in election years. So I should sort of somehow discount that.
I take into consideration more in years that it's actually working. Right, so sometimes it just doesn't, and you have to just cite it because people know what it's with. And a lot of times too, there's some sectors that do better than others, and when it lines up with volatility, typically moving the opposite direction, which it has, as well. I think too. Looking back to my beginning of my career, I started at Smith Barney with Alan Shaw and Louise Yamada, so pioneers of the industry. Alan, may he rest in peace, always used to say when he walked in the day after coming back from Labor Day, "Happy Business New Year, everyone," right? So funny, but at the same time, we can make the case that a lot of people, the heavy hitters, are not around in August. They come back, reevaluate things, and maybe that's profit-taking. Who knows? But I think it all plays in.
So I didn't realize you work with Louise Yamada. You said you worked with her? I mean, for a minute?
Yeah, started there.
So, I mean, one of the questions I always ask, we'll just do it now, kind of mentors, but let's focus on her. I mean, she is a living legend in the technical community. What is her the famous, the longer the base, the higher in space? Didn't she first say that, I think? A lot of us have paraphrased it.
Wait, say that again?
The longer the base, the higher in space. I'll let Frank explain that in a second. But just tell me some things that you learned from Louise, because, again, she's just a legend in our industry, and I didn't quite realize you worked with her. But what does that mean, first off? The longer the base, higher the space.
Well, you can have, again, bases is basically a form of a bullish pattern. And so sometimes they can be, of course, a few days, sometimes weeks, sometimes months. So the big bullish pattern I pointed out is a big base. Sometimes they can go back decades.
Yeah, like a stock that goes sideways for 3 years, just goes nowhere for 3 years. That's a big base. So potentially it breaks out, it'll start moving.
So the measured move, that's how we get targets, right? Taking the measured move, so the height of the move below the base, you basically just attach that to the move above the base, and that's where the target could be. And so a lot of times, we talk about now using log scale as well, but if you don't use log scale, you can go back and still, there's plenty of examples along the way. So Louise, I must start with the fact that she's a wonderful person, right? And that matters. And I think we all can understand that going through our careers now, decades long, that you come across people that aren't like that. And some are successful regardless, but you may meet enough people along the way that had all of it right. It starts with character. So that's the one thing about Louise. And also, she didn't start in the industry. She was in education first.
Interesting, yeah.
She took a class from Alan and then just basically hounded him for a job to basically not work at all. I mean, I'm sorry, work but not get paid. what she did, and eventually, her drive and just this desire to be part of the team led to her being hired. And by the time I got there, Alan and Louise were running the team together. And so Alan was, close to 60 at that time. And he was happy to give her some of the reins, but she really helped me along the way, just like every step of the way. And back then it was, they had a huge chart room similar to Fidelity. And my role back then initially was to update the chart every day. So literally, I was looking at the newspaper back then because 1997, the internet wasn't on everyone's desktop just yet.
So you were drawing these by hand, huh?
Literally. There's data points, but it went back like 25 years. So when, it was probably 12 feet high, the chart. And so Louise would sometimes come and like, hey, Frank, let's take a walk through history. Let's see the last time this happened. So that chart probably needed to be updated a few times from that point, just because obviously things are through the roof. But again, I was there for 2.5 years, and the experience of being there from 1997 through 1999, going through the dips of 97 and 98 along the way, and having really big name clients and also executives of the firm call the chart room to talk to Louise and Alan about their thoughts on it, because they cared about the market, probably more about their personal accounts at the time, but just knowing that they had a lot of respect. And for me, it was my first taste of technical analysis, and obviously I was hooked from that point.
Isn't it funny we call 98 a little bit of a, what'd you call it, a little dip?
Yeah.
Like, I've read the stories. I was in high school, but like, yeah, it was literally a global panic because long-term capital management goes under, Russian ruble goes under, and now we're like, it wasn't that big a deal. But in the
now
middle,
you think about 98 as, that's a fantastic year for markets.
there's a bear market in it. But we've hit the 20-minute mark, which means we're halfway done. Frank, you doing all right so far? So far, so good? Yeah.
Your Blazers keeping me alive.
There you go.
I have a question on technical analysis generally. I mean, two questions. One is, does it work on different time scales? For example, daily, weekly, monthly, yearly, or even decade level? And second question is, does it work, or maybe how well does it work for other asset classes? Right? Or even if you go from, like, say, individual stocks to the indices, and then if you go into things like commodities, oil or iron ore, or I don't know, whatever, copper, things like that, and bonds as well. So I'm curious about your take on that.
I'm going to give you a very unbiased answer. Yes, it works across all of those.
That was easy.
Yeah, exactly. But I would say sometimes more better in other areas other than the stocks, only because stocks report earnings. Stocks have micro things going on with them, of course. And, there are many CTAs, right, out there that run books just based on technical analysis. Now, could it be trend following? Like that, it could be mean reverting moves. But that, and I wouldn't even put Bitcoin into that mix, where if you look at Bitcoin over the last 10 years, of course, that's in its existence, it really pays attention to, of course, strong moves to the upside and downside. But in the middle of that, a lot of really interesting breakouts and breakdowns along the way. And again, why does it work? It's just it's human psychology, right? It's a graphical representation of supply and demand. And now with everyone so focused on it, on an intraday basis, you can see how that works out very short term as well. And again, a lot of times I think people identify where reference points are to give them a sense of risk levels too. Like, I just know from my own personal way of trading, I'm trying to identify bullish patterns along the way if I'm bullish, of course, and putting a stop loss to manage it. It's not really about a trailing stop loss. It's not about an actual number. It's when does this structure that I'm looking at, when does it get invalid, right? So if it's a head and shoulders pattern of such below the right shoulder, possibly, I don't like it anymore, right? And so you do that enough times. Just talk to Peter Brand, right? The famous trader, trading commodities for I think 5 decades now. If it works for him, if you talk to him about it, he's like, technical analysis isn't what's giving me the success I've had. It helps me manage risk because I can see it. And I think he said his win rate on trades is only about 40%. Yet I think he had an average return of over 30% over many years.
Right. It probably gets to that old saw of like letting your winners run. Exactly. And cutting those losers short. And that's interesting because it seems like risk management is also a big piece of this, technical analysis.
100%. A lot of people will say, who don't really grasp or want to grasp technical analysis in general, they'll say, just tell me when to get out because I have my fundamental ideas. And a lot of my clients do the same thing. And some of them like to trade ideas. Some of them just want to be alerted to the fact where are we in the technical cycle, what is the S&P showing, because I'm going to take down risk or get more aggressive based on what that's showing.
So again, this is episode 101 of Carson's Facts versus Feelings. Ryan and Sonu. Ooh,
I hear some thumping.
I think there's a techno thing going on next door. We're in the wrong
room. Not a brass band.
I don't know what's going on over
like
there.
A disco.
But anyway, talking charts with Frank Cappelleri. So, Sonu, I do want to talk about the inflation report that came out a little bit ago. So get your thinking cap on. But one more for you, Frank. Then we'll talk a little fundamentals. One thing that gets me with the market right now is you look at year to date. Utilities, I mean, the time we're doing this, approximately 21% gain, the top performing sector. In a past life, we've seen when utilities lead, it's usually a warning sign. When defensive things, it's a warning sign. Late 21, fourth quarter, we saw the defensive stuff really doing well, and then 22 happened. How worried are you that we're seeing some signs of the defensive things really in the leadership here?
I think it's a concern because you talk about that combined with the volatility discussion we just had. And if I didn't know anything about what the market was doing, I was just looking for interesting chart patterns that looked bullish. Utilities came up a lot. Consumer staples came up a lot, of course, and real estate. They all look great, like great charts like technology did, say, a year ago. Sure. And so just from that, I think it is a concern. And so when those charts start looking bad, you hope that you get a bid back into technology. And I think on the side of that, technology charts right now, there's no real identifiable bullish patterns. Now, they could back and fill in a very aggressive way, but what we saw earlier in the year, when I just know from scanning hundreds of names a week just for looking for buy ideas, a lot of them just from past the eye test. Clean breakouts, clean breakouts, clean breakouts. A lot of that changed in June, right? Things really expanded, not just the Mag 7, but those look very extended, and to the point where they look great in terms of the trends being very strong, but I couldn't recommend them just based on how I look at things, right? And so you have a combination of technologies, stocks being very messy now, and the likes of utilities, real estate, consumer staples looking good. It is a defensive stance.
Great stuff. But Sonu, in the models we run for our Carson partners, our Carson house view models, we added some low volatility. I mean, low volatility,
right, yeah.
These are some of those names. It's not like we're bearish, right? But talk to us. We might have talked about this one or two podcasts ago, but let's get into it again. What did we do to kind of prepare for some potential September, October volatility in the models we run, the real money that we run for our partners?
I think, and I'll rewind back even further, connecting fundamentals to, I like to follow price because price measures sentiment. We're all in the business of pricing risk in a way. And it is a beauty contest. And that's why, even though I don't do technical analysis, I'm always fascinated by it because you're trying to figure out what other people think about the data, not just what you think about the data, right? And what you think market should do. And that's what I think, all the stuff you guys do, comes out really nicely. And why I think it's important to follow that as well, and even for risk management, right? So again, going back to last year, we thought there was no recession, which means there was no need to hold things like long-term bonds. That's what you would typically hold.
Just to be, last 2023, right? That's
2023,
what we're calling 2023.
Yes, 2023.
Right, okay.
And we didn't hold any of that. Now, this year, we wrote about this in our mid-year outlook. We think risks are rising. We still like equities. We're overweight equities. Now, how do you hedge for those rising risks? You can do it with long-term bonds, which we did. We added some long-term treasuries in the portfolio. But another way we like to say, diversify your diversifiers, right? We all know that sometimes, the same diversifier doesn't work as well every time. We found that the hard way in 2022 when long-term treasuries also lost a lot of money, right? So low volatility, I think, is a nice way to diversify your diversifiers while being overweight equities, and that's what we did, recently.
And I've said, in periods of high volatility, how do you beat it? You want to be low volatility, and vice versa, for that matter. Frank, you pulled the mic up. We'll add something there.
No, I would say it's very interesting when Sono's world, your world, and my world all are saying the same thing. Right? And that's when really technical analysis comes into play very nicely. Because a lot of times, again, going back to my institutional clients, it's basically checking the box of things. Right? And so if they have a model, of course, technical analysis is going to be part of that, whether it's from individual stock basis or a macro basis. And I think you just need all these things to come back into play to get us back to, say, a more trustworthy stock market. And again, from my perspective, that's having low to mid volatility and clean breakouts. And so at the very basic things that I need to see, that needs to change again.
Yeah, that's one thing I've always found curious when people say, oh, I do only fundamental analysis, or I look at only valuations. I think that's one thing hopefully we do differently than most other people. You have to look at everything. All right? You don't ignore valuations. I mean, it's hard to time markets using valuations. I think everyone will kind of admit that. But it is a headwind or tailwind at the back of, at your back, right? But then you have to look at price as well. You have to, because that tells you what other investors, I think, are thinking. And then obviously, from a macro perspective, the fundamental data, things like that. But again, the real question is not about what the macro fundamental data did. It's about how everyone else is pricing it.
And that's reflected on the charts, right? And so, a lot of times I find it funny because I get a lot of questions, I'm sure Ryan, you too, from the press about where's support and resistance when something is falling apart, right? Going straight down or straight up, where that's when it doesn't matter, right? That's I always say, you hear the term price discovery a lot. I call it support discovery. Sometimes there isn't support, so you had to see where the support is going to be etched at, and then from that point, you turn to pattern discovery. So I think we're in this point now where you still want to see where the next support is because, for the S&P 500, you have, a level that it hit it on the low of August 5th. That's a low. You need to see a higher low now, I think, some point in the next few weeks to get confident again.
So update on the mystery pink stain. I don't see it anymore. I think it's gone.
Look at that.
Yeah. So thanks to Grant on our, I don't know where Grant.
Yeah,
Grant on our team gave me one of those.
I guess
Tide,
shout out to those
a
Tide markers.
recommendation of Procter and Gamble, but boy, oh boy, the Tide pen really saved me.
I think we need a time lapse on this.
I don't know. I tell you what now. We've got about 10 minutes to go. Sonu, let's talk about the F word for a minute here. Fundamentals.
I thought you were going to say Fed, but,
We got lots of F words. I don't know, but it's all right. We'll keep them here. So again, we're doing this September 11th. CPI just came out a couple hours ago. Initial reaction, market's selling off. Hey, it is September, like we said. What's your early reaction to the CPI data and obviously how it plays into what the Fed might do next week?
So here's a big picture with CPI data, which I think you and I have been talking about for a while, that inflation's last year's problem. I'll change that a little bit to say, I think the inflation fight, there's another F word for you. I think the inflation fight is over.
Frank's another F word. We got F words all over the place up here.
Yeah. You're just rolling in these today. No, I think, look, the inflation fight is over. Right, headline CPI inflation, 2.5%. It's the lowest in 3.5 years. It's the lowest since February of 2021. Right now, the Fed's target is 2%. They actually follow the personal consumption expenditures index, but set that aside for now. 2.5%. Here's some perspective. Last year, this time, it was 3.7%. 2 years ago, it was 8.3%. In 2020, January, it was 2.3%. 2.5 is not very far from 2.3. By the way, I think there's good reason to believe that is overstated as well. Without spending another hour on shelter inflation, we know that official BLS shelter data, and God bless them for what they do, right? I mean, goodness, the government gives us so much data. I think a lot of it is good, but it has its flaws. And I think the shelter inflation data is flawed right now. It's lagging real-time measures of rent. And you see that in core CPI, because core inflation, excluding food and energy, is what the Fed focuses on. Core inflation is 3.2%, so that's well above target. By the way, the Fed says we target inflation at 2%. They're not targeting core CPI or core PCE. They're actually targeting headline inflation. So that's an important distinction there. It's just core inflation tells them where the headline is likely to go, right? And I think that's the difference. So core is running at 3.2%. Before the pandemic, it was at 2.4%, thereabouts. So we are about 90 basis points higher than that. Almost all of that, about 85 basis points, is coming from shelter inflation. So basically, most of that excess inflation is coming from shelter. Now, it would be worrying if that was actually had some basis in reality. It doesn't, right? I think shelter's lagging, as I said, for any number of reasons. The good news, it's coming down. The bad news, shelter is coming down very slowly.
So I think we have internal rule. We have to mention Neil Dutta every time we do one of these. Neil Dutta over at RenMac, big fans. He's saying the Fed's behind the curve. They should be cutting 50. That's why the market's selling off. He's sitting. We're having
exactly. I think today's market action shows that.
So talk a little bit about kind of Neil's worry, maybe your worry, and maybe what the Fed might do next week.
Yeah, I have a new blog coming out tomorrow morning, carsongroup.com/research. I think the Fed's behind the curve. I mean, you can follow, that's the other thing, right? We quote Neil a lot, like Frank's work too. And you have to pick and choose though, right? Like, it's not like, oh yeah, these guys always pick the right guy. No, we like Neil's work because he's got a solid basis in what he does. Same thing with Frank as well. And we like a few other folks like Skanda Amarnath from Employ America, Guy Berger, who was on a Spaces with us at Burning Glass, who's one of the best labor economists there. So yeah, no, I'm in the same camp as Neil. I think the Fed's behind the curve at this point. Labor market trends are falling. The 3-month average of payrolls, monthly payroll data, is at 116,000 now, right? Including August. So that's an average of June, July, and August. That's not bad if you stop there. The thing is, we don't know if that's going to be revised lower, right? The plus-minus confidence interval for payrolls is 130,000. Now, if payrolls are averaging 160, you can be safely, confident that, okay, payrolls are likely positive. But at 116, yes, it's enough to keep up with population growth. If you stop here, if you know for sure, it's going to be 116, 125,000. That's not a bad place, right? So, but we don't know that. All the trends show most labor market indicators trending down. I think the good news is private sector balance sheets are in good shape, whether you look at the corporate sector or whether you look at households generally in aggregate as well, right? So it all comes back to the Fed. I think, it's up to the Fed whether they want to arrest these declines in labor market indicators.
So we've got about 5 minutes to go. Thanks, Sonu. We got about 5 minutes to go, Frank. One that we've had a little bit of a position in some of the models that we run since March of 23, I believe, Sonu, is gold. Right, we're not gold bugs by any means, but we see some reasons that gold do well, and gold has.
I have bought gold coins in the past before.
You're Indian, you have to. Isn't that like the rules?
Yeah, exactly. I'm Indian too.
You said, right?
But well, that's a joke. But you said your parents. What did you say yesterday about your parents?
They just invested in. They never invested in stocks their entire life, right? All they invested in was real estate and gold. That's it. I mean, as an Indian,
and how's the Indian
background, you have to have gold
for 40 years. How's the Indian
blood.
stock market done for 40 years?
It's. Okay, I'll start from 94 because it's a good place because you compare that to China. The Chinese stock market has been more or less flat, believe it or not, from 94 through the end of 2023. The S&P 500, I don't know the numbers exactly, but
probably a lot.
If you look at the MSCI India Index or the Sensex, which is a local Indian currency exchange, that's outpaced. It's run rings around the S&P 500. Yeah. And even after adjusting for currency, because the currency has depreciated a lot over that time. But even after adjusting for that, the Indian stock market has been on fire.
Yeah, thanks, Mom and Dad. Right? Yeah. So let's get to gold. What do you think of gold or other? How about this? I mean, gold's going up, oil's going down. I don't know. Talk to me about commodities, but maybe with a tilt toward gold there, Frank.
Well, I think if you're a technician, gold has been on the radar screen for a while. It's been breaking out. Just continues to do what it should be doing at that point. There's really not too much more to add than that because, again, it's two things. You can try to understand why it's happening, and there are a lot of gold bugs that were waiting for, 10 years for that to occur, right? But along the way, there were a lot of false starts. I was tracking all of them along the way, and you just have to be patient and wait for a breakout to actually work. And, one of the things we always track in our work is, one of the first times that there's a short-term bullish pattern that finally works after a long period of not, the hope is that then gets repeated to the point where it builds a foundation for a much bigger bullish pattern to occur. Obviously, that was the case with gold, whether you're looking at that over the last few years or going all the way back to the top in 2011. And so between that and precious metals continue to do well, that's turned out to be a good hedge at this point, has it in the past. Crude oil is in a different part of the cycle right now because that's been extremely frustrating because looking at some of the energy ETFs, right, OIH especially, I would put it in as a category.
OIH is oil services.
Just on a backtrack, if you would take a look at the weekly chart of OIH, anyone can pull it up, or even monthly, going back a number of years, the best time to buy that has been when it's testing this lower threshold of upper sloping channel. The average move is like I think between 20 and 30% call it, sometimes much more, to get sometimes even back to the upper part of that channel, or just even in the middle. That happened again over the last year, but the only difference was that the ensuing rally did not pull OIH all the way back to the upper edge. So that just showed maybe momentum slowing a little bit. And now that ETF is below that upward sloping channel, or the uptrend. The reason I bring that up is because it's beholden to crude oil, right? And crude oil has just been a mess, right? Now, some people think it's extremely oversold. Obviously, it's very bearish. So we know that when that happens, especially...
It's usually a bearish indicator for the economy, except I think in this case, I don't think it's telling you much about the U.S. economy. I think it's telling you a lot about the Chinese economy, but go ahead.
No, yeah, very interesting. But it's just something that we have to keep an eye on because, as you know, Sonu, the CPI is always X food and energy, right? Which... Some people could take some issue with that because everyone needs food and energy.
And you could argue, the Fed has historically said we exclude food and energy because it's volatile. Over the last 2 years, we've seen everything within CPI's basket being volatile. So I'm like, why exclude those two? And energy actually has a lot of influence even on core indicators like airfares, for example, and like food away from home, restaurant meals, because that's dependent on diesel for transport. And chemicals for fertilizers, things like that. But
exactly.
Well, unfortunately, look at the clock. We are almost at our time. Sonu, 45 seconds to a minute. How much fun we have at Excel this week?
No, this is fantastic. I always say it's all about getting together with people. And I work from home. I don't get to usually see a lot more people. No offense to my wife and kids, but the ones I see every day, and I wouldn't give that up for anything. But it's great to get together with everyone in our community, and you share ideas. And I think I was actually talking to an advisor this morning as I was walking into the hall. I was like, "What do you take away?" He's like, "I take away energy. I'm pumped for the next 6 months. I'm pumped for the next 8 months just to go out and get it."
Awesome. Frank, how's the easiest way people can follow the great work you do?
All the social media channels, either CappThesis or Frank Cappelleri, and the website, of course, is CappThesis.com. Happy to talk to anyone who visits any of the sites.
And I'm coming for the hat.
I was about to say,
there's one more.
And there's a few hats floating out there as a joke. We'll be sure to add some of the links to the stuff you do in the show notes of today's podcast. So with all that, this is episode 101 of Carson's Facts versus Feelings, talking charts with Frank Cappelleri. We are again on the final day of Excel. It's an awesome conference. If you're a Carson partner, you know exactly what we mean. If you're interested in learning a little bit more about Carson, or maybe coming, I saw we're in Arizona next year, right? Arizona,
yeah.
The JW Marriott, September 8th through the 10th. If you want to come, why don't you join up Carson, learn a little bit more. Go to carsongroup.com. We'd love to talk with you. With all that, this is, again, the last day of it out in Excel. We hit the 40-minute mark. We got to stop talking because we've got...
we'll be chased out of here.
My buddy Larry Spring. Larry Sprung's around here somewhere. Larry's next. We got to get off the stage. But take care, everyone. We'll be back next week with episode 101 of Facts vs. Feelings. Just Sonu and I doing a regular one, talk about whatever else is going on out there. And if you didn't listen to last week's Tom Lee, you got to listen to that. That was an amazing discussion with the GOAT, Tom Lee. See everyone next week. Take care. Thank you. Information provided on Facts vs. Feelings with Sonu Varghese and Ryan Detrick are for general information only and are not intended to provide specific advice or recommendations for any individual. The statements and opinions of show guests may not be reflective of CWM, LLC, or its affiliates. Past performance is no guarantee of future results. All indices are unmanaged and may not be invested in directly. Investing involves risk, including possible loss of principal. No strategy assures success or protects against loss. To determine what may be appropriate for you, consult with your attorney, accountant, financial or tax advisor prior to investing. Guests on Facts vs. Feelings are not affiliated with CWM, LLC.